Hey there, it's Jared Hamilton with the Hamilton Group at Cherry Creek Mortgage. Welcome to another edition of Java with Jared. Happy Friday. Hope you guys are doing fantastic. Hope you had a wonderful holiday weekend. Well, we got an early Christmas surprise here with the jobs number. Rates are a little bit worse. The end of this week is where they were at the end of last week. In fact, at the end of last week, through the holiday break leading up to Thanksgiving and actually after Thanksgiving, we saw interest rates get to the best levels of the year. But this week they started trailing a little bit worse, just in anticipation of this jobs number, and because the stock market was continuing to set all-time highs and records. Well, today we saw the jobs number, and it was an early holiday surprise. It was a lot higher than expected. Actually, expectations were for about 230,000 jobs added to the market. Actually, some were anticipating that was going to be worse just because the ADP number that's always released in advance came in a little bit worse than expected. But it was actually a complete polar opposite. It showed that there were 321,000 jobs added to the market, and there were also upward revisions to the previous numbers. So this actually marks the 10th consecutive month that there's been over 300,000 jobs added, or over 200,000 jobs added to the economy, which is the longest streak since about 1994. Also, average hourly earnings increased 0.4%, and so for the year, it's up over 2%, and that could be inflationary. The unemployment rate stayed the same at 5.8%. And also the labor force participation rate stayed the same as it was the previous month at 62.8. So across the board, it was actually a really strong job number. And what's also kind of a surprise is how the markets are really reacting to it. Right now, mortgage-backed securities are worse on the day, which is bad for interest rates, but not as bad as what you would expect with such a strong jobs number. Also, the stock market is up a little bit, but it's not up a whole lot. So kind of an interesting dynamic here, what we see going on. Overall, wage increases and a good job number is going to be good for the housing market because people are going to be feeling better and going to be buying houses. So that's going to be good for home sales probably and appreciation. But the other thing that's also going on is that these wage pressures with the average hourly earnings going up is also inflationary, and that could be bad for interest rates, which could cause the market to cool. But as long as the stock market is not reacting massively better, then it's kind of helping interest rates a little bit from being worse than what they should. So the stock market's looking at it as, well, this could cause the Federal Reserve to actually increase short-term interest rates, and that's the Fed funds and discount rate. And the stock market really likes all this extra stimulus to the economy. So it's a real tug of war here. What this could indicate is that interest rates could begin trailing a little bit higher. But again, there's just so many other things to consider, like what's going on in Europe, and if the stock market believes that this could cause the Federal Reserve to increase credit, which could hurt the economy, and then if also Europe continues to have problems and the dollar actually goes up, we could see the stock market go down, which would then help interest rates. So just kind of a strange time. I mean, the bottom line is that we know interest rates are fantastic right now, and that home prices are going up, and we need to let our clients know about that. So that's what's going on with interest rates. We'll keep you informed with next week to see if this continues and anything else develops, as we always do. If you're working this weekend, so are we. Hope you have a very wonderful weekend, and hope, again, you had a wonderful Thanksgiving. And thanks for joining me with Java with Jared. Bye-bye.